So we're going to kick off this session. You're all very welcome. The session is on ESG and investor relations. And my name is Dorothy Maxwell. I'm the Senior Sustainability Director at Davy Horizons. I'm also a board member of the Institute. I joined just in the last couple of months. And also in Davy Horizons, we host the ICRS Ireland Hub, which we launched just a few months ago. And that's where myself and also our panelists join you from today. So the aim of the session is to bring practical experience and also insight on environmental, social, and governance, ESG, because of course it's a really fast-growing area within our profession. And I'm conscious for some of you, ESG might be new, but some of you may be operating in the space for a while. So I think whichever end of the spectrum you're on, today is a great opportunity to learn more, and particularly because we have some serious seasoned professionals with us. So let me introduce you. Delighted to have our panelists with us today. First of all, we have Garrett Quinn. Garrett is the Group Chief Sustainability Officer at FTSE 100 company Smurfit Kappa Group, a world leader in paper-based packaging, if you're not already aware of them. And also we have Brian Kennedy, and Brian is the Senior European ESG Fund Manager with Mediolanum. So you're very welcome, Garrett and Brian.
Thank you.
Thanks very much.
So let me tell everybody a little bit more about your background, because of course, all of us in the Institute are sustainability, ESG, corporate responsibility professionals, many languages, but this is of course what we're going to talk about today. So let me introduce them and give them more information for your backgrounds. So Garrett is Group's Chief Sustainability Officer since July 2021, but before that was Group Head of Investor Relations for 5 years at Smurfit Kappa Group. And he joined the group in 2000, and he's occupied a number of roles on the operational side of the business globally predominantly, but he also really understands the business from the bottom up in those roles. And Brian Kennedy is a senior equity portfolio manager at Mediolanum now. He specializes in ESG and low carbon strategies. But before that, Brian managed ESG and climate change focused funds for over a decade at Davy Group and at Allianz Global Investors. And there he focused on one of the world's first sustainability funds, the Allianz Global Sustainability, which launched in 1999. And Brian sits on the Irish Steering Committee for CDP. He's on the Global Investors Group for Global Reporting Initiative, GRI, and he's a steering committee member of the ICRS Ireland Hub. So on housekeeping, our discussion is going to last about 30 minutes. We're going to have a Q&A session, but this is an exchange. That's the whole purpose of this summit today. So please do add your questions, add your comments to the chat box. So we're going to leave plenty of time to take as many of them as we can. So Garrett, if I could start with you first. I'm going to come to your current role as a Chief Sustainability Officer, but first of all, I wanted to ask you about your Head of Investor Relations role. You've been in that role in a FTSE 100 company from 2016 to 2021. Amazing experience. Can you share with us a few key thoughts on how sustainability has become an integral part of the investor relations role?
Thanks, Dorothy, and good afternoon, all. Well, yeah, I guess I'll certainly give a view in the 5 years from 2016 to 21, where we coincidentally 2016 is when we entered the FTSE as well. So I guess it's kind of our live experience in the UK primary listing previously with a primary listing in Dublin. I would say, again, I'll give you an overview and you can decide whether you want to go into a bit more detail. I would probably, and hard to be very kind of, this is the year where it started, this is the year where it finished. So I'll kind of give us a sense as to what I experienced. And I would say 2016 to 2018 it was probably less a focus. I'd say it was more, specific hard-nosed ESG funds where you knew that was their mantra. It had been their mantra for 5-6 years beforehand. They would hold you to account and challenge you on certain aspects, but they were in, I would say, the minority in terms of our shareholding. And then when you met the vast majority of current or prospective investors, I would say there was limited inbound on that, on sustainability related matters. In 2018-19, again, hard to say exactly when. I would say it certainly changed. I think it started with I'm under pressure from my stewardship team to show that I've done due diligence. You score well on Sustainalytics, you score well on MSCI. I've ticked the box. Thank you for that. Let's move on. Now, let me ascertain whether you're a cheap stock or not. And then I would say 1920 is really where you saw a step up and noticeable with myself and my colleagues, where we were meeting portfolio managers who had met for 5 years. And now they're asking us about our water risk assessments. They're asking us about certain aspects of how we manage our gender diversity targets. And it's great because it's engagement, but your immediate reaction is, oh wow, so this is starting to becoming, this isn't just about the hard-nosed ESG fund that it was in 2016. You now have the generalist PMs who are doing their due diligence, and it didn't feel like it was I need to go through these questions, bear with me. It was very much, this is part of my role now, and I need to go through those questions. So I think that is probably how I've experienced it over the last 5 years, if that answers your question.
It does, and fantastic insight. And it sounds like, since 2018 onwards, this has really, really ramped up and become central. Brian, during that time, you've been sitting on the other side of the fence, and for time before that, you've been evaluating companies like Smurfit Kappa as they've made the transition on sustainability. Can you share your insights on the growth of ESG asset management?
Absolutely, and the growth has been nothing short of phenomenal in the last couple of years. It's really accelerated in the last 2 years in particular. In the last 12 months, according to Morningstar, nearly 800 new sustainability-focused funds have launched, which is absolutely staggering. And then we think about that in AUM terms. If you look at research from the Global Sustainable Investment Alliance, which publishes a survey every 2 years, and well worth having a look if you want to get an idea of the pulse, or put your fingers on the pulse of the asset management industry and the sustainable investment industry in particular. They put the total AUM, or assets under management, in sustainable investment strategies at $35.3 trillion at the moment. So to put that in context, that's about 36% of total assets under management globally are now sitting in sustainable investment funds. In Europe, that's slightly higher, it's 42%. And in the US, we see that at 33%. But we see that the acceleration in growth in the US has probably been the most profound. And what's interesting, I find, about this is that a common sort of refrain that you might get is that sustainable investing, it's really just all about institutional investors, about your pension funds, about your charities, about your large corporate schemes. But in fact, what we're seeing is a massive acceleration from retail investors. So now, of that 35.3 trillion that I talked about, 25% of that comes from retail investors. This is me and you. This is the people on the street looking to put their bit of spare cash to work. And that is now representing a decent proportion of total sustainable investment AUM. What's more staggering is that was just 11% only in 2012. And that reflects the growing awareness of sustainable investment among your typical investor. I'd say another thing that I found quite interesting looking into the numbers is that we have, where a couple of years ago you might have seen very few different flavors of sustainable investment. Now we have quite a few, and you could broadly bucket those into your thematic and sustainably themed impact investing and your broad ESG investing. So the thematic or impact investing is looking to target specific sustainability trends such as climate transition, such as climate change, water conservation. And these have seen an absolutely rapid acceleration. So between 2016 and 2020, that's a 63% increase in AUM in those funds. And meanwhile, traditional ESG funds, which may seek to invest on the best stocks within a given sector on a relative basis, according to frameworks that might be external providers such as MSCI or Sustainalytics, or through companies' own individual frameworks, that growth has moderated slightly. That is an area of the market that's maybe matured, but the real growth is coming through in those thematic areas. So I guess the bottom line from all of this is that it's increasingly clear to me that in order to remain relevant to the broadest cohort of investors possible, companies need to demonstrate a genuine commitment to sustainability. And this extends beyond just having some snazzy marketing, but this really goes as far as the organizational structures, which is to touch on what Garrett mentioned already.
Okay, really, really interesting insights you've both given us there. And what I'm hearing is whether you're on the corporate side like you, Garrett, and you're being asked for the information to prove that you're absolutely part of the solution, not part of the problem on your material sustainability issues, or whether you're on the asset management side like you, Brian, actually looking at the investments, the acceleration of the drivers, as you used, the phenomenal growth really just reflects a mainstreaming, and that this is not just sitting also in a niche area of investment from your perspective, Brian, anymore. This is actually really mainstreaming across funds. And I've seen that in Europe, the stats are saying that the ESG label, if you like, in terms of funds, are going to constitute the majority of assets under management within the next 4 years. So that's very much aligned with what you're saying about Europe being a little bit in the lead at the moment. Okay, so this to me says ESG absolutely core part of our world as practitioners, whatever you want to call ourselves, sustainability, ESG, corporate responsibility. This feature is absolutely core. So let's look at your role a little bit more, Garrett, because we probably have some chief sustainability officers joining us in addition today. So this is really a role, this green seat in the C-suite, where it's a cornerstone fixture for senior management. You are the ambassador driving sustainable change. You're a bridge between the executives at the board level and also the broader operational parts of the organization. Can you take us through how your current role is structured and how sustainability fits into the DNA at Smurfit Kappa?
Yeah, sure. So I guess the good news, I guess, from our perspective, or certainly we believe, is it's not new. This isn't something we decided on, as I outlined my 5 years in IR, that we decided there's gold in them hills, let's start reporting on sustainability. We've been publicly disclosing and publishing our sustainability report for 14 years. And it's been independently assured for over 10 years, which is something we may touch on, because I think that is going to become more and more taken as the default rather than a badge of honor. But the role itself, I report to the CFO, which is probably a nod to some of the areas you just highlighted. Previously, it reported to the CEO. I think the primary reason for that is we see the reporting obligations in the whole area becoming more and more onerous. And so we see, whilst nothing is written in stone yet, we see that probably the finance function will have a much stronger hold of sustainability reporting than probably it had in the past, where in the past, from our perspective, it lay with the health and safety, quality and environmental managers at plant level, and then consolidated at group level. So when we see where, defining your taxonomy alignment, when we see the double materiality and the CSRD obligations that are coming down and continuing to evolve, when we know we've got ISSB coming in the future, we're saying, okay, how are we going to configure ourselves best to make sure that we stay ahead? And so I guess that's where the fitting under the CFO became a strategic move, with a very strong dotted line to the CEO. Also a member of the Board of Directors Sustainability Committee. So that would be chaired by one of our non-exec directors. And then I'd be the chair of the executive committee on sustainability. So where we would have the CEO, CFO, and the operational leads on that committee as well. So fairly strong, call it governance from the board down to senior management, and then that cascades all the way through the business. I would say also on top of that, we've increasingly been integrating how sustainability is just part of how we fund our business. So we have a sustainably linked revolving credit facility. We issued our first green bond back in September. Our incentives, senior management incentives, are all linked to the delivery on our sustainability KPIs. So we can see how it, as we go forward, is just becoming more and more part of what we do, how we fund ourselves, how we reward, how we sell to our customers, how we attract employees, how we retain employees. It's just, as I said, it's increasingly just part of what we do. And I guess the CSO role is an evolution of what was there before. There was a VP of Development and Sustainability, but the CSO role, I think, is seen as a kind of someone who well, hopefully someone, me, who is going to coordinate and, as you said, be that ambassador within the company and outside of the company. So how do I establish those partnerships with customers, establish those partnerships with suppliers? Not necessarily to be doing every single one of them, but trying to get your kind of Pareto stuff. Where's the biggest bang for our buck in terms of the customers that have aligned interests, so that we can just get more and more of a business case for being even stronger on our sustainability credentials. So we have at least a net zero target by 2050. But I guess the question I'm asking is, well, what would happen if we hit it earlier? Could we win more business with our customers if we were able to do that by 2040 or 2035? And, it's almost like create the commercial carrot and then let's worry about the technical solution that facilitates that. So just trying to change, I guess, the business to be a bit more, what's the word? More of the business case, more than the compliance and risk that was probably the dominant feature of it in the past.
Okay, that really is an evolution. And you mentioned there the connection with the business case, the financial part of the organization, and even your reporting line into the CFO very, very much speaks to that. And you talked about the green bond. So you launched an inaugural green bond offering in September this year. Can you take us through that framework? Tell us a little bit more about it.
Yeah. Well, essentially, as I said, it was probably just an evolution of what we were doing. We'd already done the sustainability linked aspect of our RCF. We were looking at raising, looking to go to the market to raise debt, and so we felt that it was a natural evolution that we would do it. And that we had an opportunity to demonstrate the environmental benefits of the business, our operations, and how they contribute to the achievement of the UN SDGs. So when it comes to how and kind of framework, the technical aspect, the framework, when we published it, it was aligned and is aligned with best market standards. And when we say, well, where does that come from? It comes from the ICMA Green Bond principles from this year and the LMA Green Loan principles from this year. So, this is where my colleagues in Treasury would be able to go into the nth degree of technical explanation. But essentially, it was us putting out our green finance framework, linking it to working, actually selecting green bond advisors as well. So picking specific advisors that would work with us. And then generating a second party opinion. So getting a second party opinion to say to what degree is this green finance framework doing what they say they're doing? To what degree is it aligned with those green bond principles? And thankfully, which is all public on our website, you can see we got a very strong second party opinion from ISS. And when it was kind of what was the core focus, it was financing or refinancing existing or new assets and expenditures within the circular economy, which we're one of the largest recyclers in Europe, recycling over 6 million tons of post-consumer corrugated waste each year in both Europe and the Americas. And then the second part being the environmentally sustainable management of living natural resources and land use. So that speaks to the whole renewable, sustainable management of our forestry assets, which, albeit 25% of our business, still a very important part of our sustainability story, and something which was a cornerstone of the green bond. And then beyond that, I think it was, probably the last bit, which might be interesting to the audience, is we did get questions on taxonomy alignment, which again speaks to what's coming around the corner. And our current, the taxonomy, the business activities, we're not covered yet. So what we did in conjunction with our advisors is we went through what existing guidelines are there with Brussels. And so Brussels had already published the classification for the transition to a circular economy. And they said these are business activities which are well placed in this transition. And thankfully, we were able to point to that when we met with the debt investors as we went through that process. Since then, we've seen the draft legislation on the food and beverage section of the taxonomy categorization, which again, thankfully, speaks to the use of packaging in that sector. So strangely, the taxonomy doesn't cover us yet, but it covers our product as part of another sector. And we can see that it is well positioned in the recycled. So they want product that is made out of recycled material and or products that is packaging products that are made from renewable materials. So again, thankfully, well positioned vis-a-vis draft categorization from the EU and existing guidelines that are out there. And it was a fantastic success. It was 7 times oversubscribed. It was a record low coupon for a corporate globally of our credit rating. So we were absolutely delighted with it.
Okay, and when I hear you speak about that, what I'm struck by is not just the integration at the heart of finance, of sustainability at the heart of finance in terms of what you do, but it's also the rigor that sits behind that, which of course is, and the accountability, which is incredibly important in the sustainability world. Brian, if I come to you, when you hear from the asset management industry's perspective, a company like Smurfit Kappa with a chief sustainability officer tying the targets to remuneration for the senior executives, how is that perceived?
I think that's, I would put that as the gold standard, really, in terms of how we would look at a company. I mean, I think at a very base level, we would want to see disclosure, an excellent level of disclosure. And second to that, then some target setting would be nice. Of course, we want to see net zero as the ideal there. But then beyond that, it is that point on accountability. It's all well and good being able to set a target for 2050. And I think that's very easy for someone who knows that they're not going to be in their current role to do down the track. But if a company is able to align their management remuneration and in line with short and medium term decarbonisation goals, that is really the gold standard of what we're looking for. And going back to the role of the CSO, I mean, we would like to see that the CSO's remuneration also reflects the performance along these goals. And the incentivization for CSOs is very important, and that'll be something that we would look at when assessing a company. So to answer your point, I think incentivization is increasingly where the rubber meets the road in terms of assessing a company's intentionality around decarbonisation.
Okay, really, really interesting. And just doing a time check here for those with us, my colleague Amy is going to be joining us shortly. And if you have questions, comments, pop them into the box. She's going to be taking a look at those and we get through as many of them as possible. But before we do that, so we've mentioned a couple of terms here that mightn't be familiar to everybody in the room, things like the EU taxonomy. in my current role, I talk about it that I sit in the worlds of sustainability, which as an environmental scientist and coming up on about 25 years experience, I'm at that more operational side that you talked about, Garrett. That has been my safe space for many years as a practitioner. But I come into a world where also I'm engaging with what we're calling separately the ESG world. And what I'm finding now is that those two worlds are coming together. And in a way, it's science meets finance. And, you know, I've always focused on sustainability in business and how you apply sustainability solutions. And actually, I can't see any way for us to achieve our goals on sustainable market transformation, particularly in the urgent timelines that we have, if we don't have the financial community. We're never going to scale. So this to me is absolutely essential. So Brian, if we look at data, what companies like Smurfit are being asked for, what you are looking for to prove credibility in your world, we have the EU taxonomy, we have the sustainable finance disclosure regulations, we have TCFD and discussions hot off the presses at COP26. So we have the worlds of finance looking at this, and we have the worlds of corporates looking at it. What is your view on, are we starting to speak a similar language and ask for similar data, or are we still far off that?
Yeah, I mean, I think there's definitely some homogenization there in terms of what is being asked of companies, and I think the common frustration, speaking to multiple companies, is that you know, there are such different and sometimes diverse requests of them coming from investors and coming from the regulation side. So if we get some alignment on those, I think that will be welcome for everyone. Now, from the investor perspective, you always want to be able to get an edge in terms of the information or the knowledge that you have. So sometimes being able to gain a little bit of asymmetry by finding out some information that isn't necessarily quite in a set of sustainability reports can be the advantage that you need to find the stock that is going to deliver those outsized returns. But at the same time, I mean, I think I would have to say welcome some sort of standardization of approach. It means that when you're engaging with a company, you can point to specific standards. And it's interesting that we talk about something like TCFD. I mean, I think TCFD for me is a particularly relevant piece of disclosure when it comes to companies who are, say, the larger carbon emitters, because it allows a company to give context around why and what they are doing around climate change that might not necessarily come across in a headline number. So I think TCFD has certainly a place in terms of the larger emitters and for the broad and for the broader set of companies out there. But yeah, I think that greater alignment is fantastic, and it certainly helps the engagement process, to answer your question.
Okay. And Garrett, from your perspective, you know, your data demands, you were saying earlier, just growing dramatically. And of course, there are way too many benchmark standards and schemes. That's one of our challenges in sustainability and ESG. Are you seeing commonality and integration starting to cut through?
I think you might have mentioned it there a couple of minutes ago. I think there's intention or ambition to harmonize. So we can see IFRS getting stuck in. My understanding is that will almost be kind of like a base level that everybody can sign up to, and then almost by jurisdiction you start adding on your layers on top, which I guess it's good because it means if you kind of if IFRS deliver on that, then you know you almost, as I said, you have that base point. The part for us, and again I can only speak on our behalf, our access to capital would predominantly be focused on Europe, UK, North America, so for us that's where, again, selfishly speaking, we would like alignment. You know, you don't want to hear the UK flying solo and then, you know, Canada taking a view on nuclear, and then the US saying we love nuclear, you know, gas winning in Europe, and all of a sudden you've got different views on what is a green energy mix for your taxonomy alignment. So, the word I've heard, the technical boffins, is this whole area of interoperability. In brass tacks for us as a corporate, you just don't want to have additional layers of unnecessary disclosure. Additional layers of disclosure are fine if they add value and they're on the right aspects, but not kind of saying the same thing in slightly different language because that's what Canada wants, or saying the same thing in slightly different languages because that's what the US wants. Because then you just go, that's paperwork for paperwork's sake. So hopefully it would appear, you look at the UK, it's only out a few weeks. It seems to be very similar, certainly at least an approach and framework. But they seem to have the door very open, or certainly my understanding is on nuclear, where Europe seems to be going the opposite direction. So there's lots, I guess, still to be teased out in that. And for us, what we really want is less. So back to your question on resourcing it speaks to why, I guess, the CSO is reporting to as we mentioned earlier, the CFO. And I think there's also an element where we can see that the CSRD is going to just drive more disclosure, the need for more frequency of reporting, at least for us operationally, so that we know when reporting is required, and we're all over it. And I think the other aspect, which is a dynamic aspect, and it's one of these opaque areas which you'll all have views on, is the third-party rating agencies and what part do they play going forward. And the sense I get is that you've got large investors who are saying, actually, we have our own proprietary approach to sustainability, rather than, we only invest in MSCI AA or higher sector leaders, or whatever it might be. However, so far, when we've scratched and when we've asked those investors, but where are you getting your raw data from? They go, oh no, well, we're still getting it from Sustainalytics or MSCI, but then we take it and we do our own interpretation of what's okay and what's not okay. So it kind of, there's a trend that might mean that, getting your AA in MSCI or AAA is still important, but actually, which should be the same workflow anyway from a corporate perspective, just making sure the data is clean, so that even if well, I won't start naming them, but all the household names who'd be the top 10 investors in the world, that if they start saying, well, this is our own proprietary approach, we still know, or we believe that they'll be using the Sustainalytics and MSCIs of the world as the raw data provider. So it still means that just because they're a big holder and they say they take their own approach, you need to make sure your data is clean and accurately represented by those third-party rating providers. So kind of a double-pronged approach should still just mean you need to be more active, because again, I think it's momentum is often an important aspect of capital markets, and you don't want to be on the wrong side of momentum just purely because you didn't engage with one of these rating agencies and you fell out of an index or something.
Okay, they're really good points you make. And in case people aren't familiar, so you mentioned the ISSB early on, and you circled back to it in terms of the integration piece around standards, the International Sustainability Standards Board, which we hope will bring the thinking of many parties together, many different standards around disclosure and reporting together. So that's a very important move. And then the rating agencies, which I'm conscious operational related sustainability practitioners may not be that familiar with, but what you're saying to us, Garrett, is that you have the MSCIs, the Sustainalytics, that are taking the data that's publicly available for companies that are establishing a rating, they're establishing a view, but also a proprietary lens. And we see that also with institutional investors. They've got mainstream sustainability professionals assessing the data now also to bring that. Brian, what was your view on that from the asset management perspective? Where is that going?
I mean, I'd say very much the rating agencies, depending on the level of sophistication of an asset manager, I would say that people are either entirely reliant on the ratings agencies. And Garrett mentioned, say, people who are saying, look, we're not going to invest below a single A rated MSCI company. Towards the more sophisticated companies, asset managers, I mean, when I say that, who will look at it as an opinion. It is quite simply that. I mean, there are plenty of flaws and issues around how MSCI and Sustainalytics grade companies, from how companies are peer grouped through to how up to date some of the data that is used in terms of building their ratings is. But it nevertheless is an opinion, and it is validation. If a company is considered AAA by MSCI, it is a form of validation. And it would be a very brave investor who would say that a company who is considered to be top of the pops by MSCI or Sustainalytics is actually a below mediocre ESG company. And I think, the common thread that feeds through a lot of the rating schemes is very strong disclosure, very high levels of timely disclosure, and being on top of areas that are maybe considered by some to be optional extras, like TCFD, being on top of that variety of reporting, and having a good level of intentionality around how a company discloses, and how those how that data is managed. It's one thing, obviously disclosing, but most companies and most more sophisticated investors would want to see some sort of progression in terms of a company's, say, their carbon emissions level. It's not about creating absolute levels or cutoffs whereby we won't invest below a certain area, like we talked about with the ratings, but really managing that progression. Whether that is a level of a company slowly decarbonizing, a company, say, building up their, including some sort of sustainability link to their incentivization scheme for management. Those sort of points are part of the evolution of a company. That's what we want to see.
Perfect. Thank you, Brian. And Garrett, earlier on, you mentioned your Smurfit Kappa Group's focus on net zero and your vision to be net zero emissions by 2050 or earlier, which is fantastic. In the asset management industry, Brian, we see this as well. We've got, for example, the Net Zero Asset Managers Initiative. It's made up of 1/3 of total AUM worldwide. That's incredibly impressive. So for a group like that, how do commitments like that start to impact individual stock selections right now?
Yeah, I have to say, personally, I'm a little bit skeptical of some of the investor initiatives as a whole. I think sometimes it can be a little bit of collective backslapping. And in my career to date, I'm yet to see an asset manager removed from one of these initiatives for failing to live up to the standards, say. But I would like to emphasize that I think I'd see net zero, it's simply part of the equation. And we spoke already about how some companies are at different stages of evolution, and you need to appreciate that. For some companies, it is a case of making sure that their disclosure is up to scratch. And then moving on from that, as a second stage, it is really what gets measured gets managed, and setting targets that are achievable and creating structures for assessing performance of those targets. And then that comes into the accountability point that we mentioned earlier, that sort of building incentivization around decarbonization in the short and medium term, and not just allowing executives to commit to something that they're not going to be around for if they fail to be on target for that.
Yeah, and that's part of the problem. 2050 is a long way away in business cycles and government cycles, so it's not necessarily this CEO or CSO that's going to be responsible.
Well,
okay.
Just before on that, let's start 2050. Just kind of hang out there in that context. We do have aspects of the integration of our sustainability targets that are annual, whether that's the incentive or even on our RCF. If we don't hit at least 3 of our 5 sustainability KPIs in our RCF, we don't get the benefit. Sorry, it's 5. You have to hit all 5 to get the benefit. It's 3 not to get a penalty. You hit less than 3, and so you get hit. So we are, that's annual. So that is tied to an annual progression. And then, on the simple thing with carbon, and I do empathize completely with Brian. The World and Its Mother came out in, I think it was September 20, with net zero commitments. Like, it just became net zero bingo, and then there's another corporate, there's another corporate, there's another corporate. So our focus has been showing the ambition of a long-term 2050, and we do say at least by 2050. So can we do it quicker? And as I said, that's something I alluded to earlier. And then we have the interim target of 55% by 2030. And then what's even more important for me is being able to say, and guess what? 2020 versus 2019, we went from 33% reduction to 37% reduction. So in just year on year, we've improved by 400 basis points. So it's that kind of combination of long-term ambition, mid-term targets, incorporating it in the incentives now, so that it's not just we're lofty ambitious, but we're not quite sure how we're going to do it yet.
Yeah, no, absolutely love that approach, and really helpful to hear it from you. So we're going to turn to some questions. I'm going to bring in my colleague, Amy O'Dwyer. Amy is an associate sustainability practitioner with us in Daily Horizons, and she also coordinates the ICRS Ireland Hub directly. So Amy, you're very welcome, and I'll pass over to you for the questions.
Thanks, Dorothy. Hi, everybody. So yeah, I'm going to do the Q&A. So if you have any questions, please feel free to add them to the Q&A box and we'll go to them after this. But to kick things off, as today's conference is all about owning the table, I'm going to start with this question. So how can we better join forces across our organisations to deliver positive outcomes and impacts for our organisations and stakeholders?
Who's that for, Amy?
Yours, Garrett.
So you're going to start, Garrett, while Brian is thinking about that one. So this is like the connecting the dots one about the science meets finance, so we're all starting to come together, right?
Well, I think and I'm not sure if it's answering the question, so please reserve the right to put it in the Q&A chat box. He didn't answer the question. I would say that, how do we work together? We all, and this might sound a little bit cliched, we all need to hold a mirror up to each other, and we all need to make sure that we are reporting on a consistent basis, which goes back to, let's make sure regulation doesn't thwart that idea with the different jurisdictional taxonomies. Something that is hopefully, and I say that because we're in the middle of looking for validation, something like the Science-Based Target Initiative. So if you are saying we're serious about our net zero, well, are you getting your targets science-based validated? And as I said, I say that with a fingers crossed, because we are mid-validation. So hopefully that will be forthcoming this side of Christmas. And I think it's that level of assurance as well. So when you start disclosing, if you haven't started on that journey, or if you are already disclosing, certainly if you've got exposure to the EU, you need to have that assured in the next probably 2 years. So if you're not contemplating having that assured, you need to get on that bus and start looking at, well, what does that mean? I don't think it's clear yet if it means assurance on the whole report or just part of the report, but essentially it's I'm sure assurance on the whole report is coming at some point in the future. So that is something to bear in mind. So at least then when people like Brian or even a customer wants to say, well, who do I partner with? You're going to hopefully start partnering and being rewarded with the people who are doing the right thing and that are independently verified.
Yeah, I mean, to my point, I guess it's quite similar to Garrett's point. I think you've observed that greenwashing is endemic in both corporate side, I think, and also in the asset management industry. I appreciate the honest dialogues that sometimes you have with companies that sometimes become educational pieces that are, you move away from box ticking and say, okay, we don't disclose this because we think that this metric is irrelevant to us. And we're going to tell you exactly why this is irrelevant to us. And that helps me to understand better how to assess companies. And it becomes more of a circular dialogue at that point. I'm learning about what are relevant metrics for a company in paper and packaging industry. And as a result, I feel more comfortable investing in a company. I feel like I am more, it's more of a dialogue than just a box ticking exercise on behalf of the corporate. That would be my take on that question.
I think you've definitely answered it. Amy, I see two
Thanks.
in the chat box as well.
Yeah, so we'll go to the chat now. Don't think I can see these ones, Dorothy.
I can. So I'm
Okay.
going to start with one on the theme of greenwash. This is a great question. So Paul, thanks for your question. Also on the board of the ICRS, Paul Burke, you've asked, given that the head of audit at PricewaterhouseCoopers recently said that corporate declarations on greenhouse gas emissions are at risk of greenwash, especially in Scope 3, because of poor quality models and assumptions, what faith do investors place in greenhouse gas assurance statements from the Big Four and others? And for companies, for you, Garrett, if the statements aren't seen as credible by the auditors themselves, how do the benefits align with the costs? So a super question from both of your worlds' perspectives. Brian, we start with you on that one.
Absolutely, yeah, it's a great question, and I would answer it by saying I put very little stock in Scope 3 emissions, basically because I think the level of comparability is really, really poor. I would say the level of assumption is enormous, and I think sometimes companies who put their best foot forward and try to make those disclosures as in as much good faith as they possibly can, sometimes end up looking worse. They sometimes end up with a bigger number than if they simply try to greenwash it. So I put very little faith in Scope 3 emissions. I would consider it in terms of best efforts basis. I think if a company is willing to put effort into their Scope 3 emissions, I think that is a big tick for me, as opposed to saying this company has higher Scope 3 emissions than this company, therefore they are a bad company. I think it is about best efforts at present, and hopefully that changes, but for now, that's where we are.
Garrett?
Yeah, I again, if I read the question correctly, I think it plays to some of what I mentioned, where if people are committing to carbon reductions, and if there's this, I must admit I wasn't familiar with that statement, but assuming it's true, that hopefully SBTI is one mechanism. It doesn't mean it's the mechanism, and it doesn't mean it's absolute, but certainly I can tell you from first-hand experience, and I can also kind of give a wry smile to Dorothy, because you warned me many months ago about the how difficult it was, and well, how challenging it was, and it's exactly what it is. So you kind of, when you get to someone who's worried about greenwashing on carbon reduction, and then you say, well, are you SBT aligned? As I said, personal experience, it is extremely robust and rigorous, and as I said, fingers crossed we'll be reporting on being on the right side of that in the coming weeks. And I think the other bit, which it might just be anecdotal, and I'm not sure if Brian might just kind of guffaw this, but like, can you see the corporate disclosing on physical actions? So back to that 80-20, well, actually I can very clearly see they put X million euros to work, and they've replaced, call it a coal boiler, with a this, that, and the other. So you start to add all the things up to say, well, look, these are big projects. That's 40,000 tons of CO2. That's 50,000 tons of CO2. So I've got SBTI alignment. I've got, I'm sorry, this is all Scope 1 and 2. I possibly should have said that from the start. So for the 1 and 2, because I'm not sure if that comment on PwC was, well, I got the sense that it was in totality on GHG, not just Scope 3. So certainly I think if you can see SBTI alignment, depending on the industry, then your Scope 3 comes into play or not. I think it's, can you see evidence of investments and real tangible CO2 disclosure? What am I getting from that investment? I'd say that should hopefully help you. And look, the third party assurance, one of the big four, who shall remain nameless, said to me that having them assure your reporting is a stronger endorsement than a non-big four, because the impact of them not reporting it accurately or not assuring you accurately is much more reputationally damaging than, call it, a third-party verification outfit, which is smaller and maybe you can kind of have more sway over, was the sense I got from that exchange. So I think there are ways and means to be more comfortable. Will it ever give you 100%? Confirmation, probably not, but certainly can it give you peace of mind that you're back in the right horse? Yeah, I would have thought so. There's a few things out there that should allow you to do that.
Okay, they're really good points, and you know, I think the third-party verification to best practice like SBTI is a really good point. And even on scope 3, we do a lot of that, increasingly being asked for that. And of course, you can have that target verified as well, which again helps in terms of challenges with data as well. So Amy's got the chat box now sorted, so she's going to pop back to another question. I think there's a good one for you here, Garrett.
Thanks, Dorothy. Yes, good. Now I have access to the Q&A. So there's a question here that says, do you see a standalone board sustainability committee as best practice, or is it better to be integrated into the remit of the audit committee? So sustainability is viewed alongside financial and other commercial risk management.
Excellent question. And I would say I run the risk of not doing it justice, because I would say we've only had the sustainability committee up and running for 2 years, so it's I haven't been involved with the audit committee, so I can't speak to the rigor. But from what I hear secondhand, it is or thirdhand, I should say, it is pretty comprehensive. So it's back to kind of Dorothy's questioning earlier, where I'd say back in 16, 17, when I was meeting those investors that I said were hard-nosed, they would have probably marked you down for saying, oh, we've moved the reporting line from CEO to CFO, where, back to your point and that question, that maybe there is a rationale to integrating it into the audit committee. I'd say it's probably a little bit early now. I run the risk now of being shot for even endorsing it, but I think it's a bit early for me to be saying that's the way forward. But certainly an excellent question, and it's something which I'm speaking to fellow corporates across Europe, where I would have expected integrated reporting was, default. It looks like that's where EU legislation is going. But again, speaking to some of larger corporates with far bigger resources than we have, they're saying not necessarily. They're actually seeing the opportunity for separating those reports to really maximize the impact, so that the sustainability report is still a standalone. So I'm not even sure if the integrated piece, which probably still think it's going to happen, but it's not as much of a slam dunk as I previously thought. A bit like that, do you end up potentially diluting the sustainability goals and strategies of the business by integrating it under audit? But then the flip side is that, could it also be perceived as you're up in the ante and how it's perceived from a materiality and a risk perspective? So I think that's probably the challenge to the existing sustainability board committee, is how do we ensure to all our stakeholders that it is meeting its charter, it is meeting its mandate, and that you don't need to worry about it being put into an audit committee. But I hope I'm not over talking it. I think it's an excellent question. They're my initial thoughts on it, though.
It would fit into, I have kind of 3 go-to questions or points around reporting lines and the role of the CSO, and those are, who do you report into? And ideally you want to see CEO, CFO, board. Then also, do you sit on any executive committees? And the gold standard, I have to admit, and it's insightful to hear you talk about there, Garrett, would be that you are integrated into committees like an audit committee, say like a risk committee. That's how I would have seen the gold standard. And then finally, how are you remunerated then would be what are the moving parts on the variable component of your remuneration. Those are my kind of 3 go-tos. So I think that it's insightful to hear you talk about that.
Yeah.
Thanks, Brian. Thanks, Garrett. That's great. Yeah, I'm going to move on to another question now that we have in the Q&A box. How do we all as professionals keep up to speed as our profession evolves, and how can the ICRS support ESG professionals?
I assume that's to Dorothy, but I'll...
Well, taking both of you, sustainability and ESG professionals, and a professional association as we are in the ICRS, how would you day to day feel that the ICRS could help keep you up to speed, given it's such a fast moving field?
From a corporate perspective, I really like simplicity. So I think if there's any way the ICRS could say, here's your must-have section, and here's your optional best practice section, then very clearly, you can decide on where are you in your maturity of reporting, disclosure, so that you can say, well, I'm only starting, and we've only just gone public, so maybe I'm doing the must-haves, but my ambition is to get to the nice-to-haves in X number of years, and as we know, that must-have list is getting bigger and bigger each year. So it would need to be a dynamic list if possible. So I think that would be a fairly simple response at my end. So that's my Santa wish, ICRS.
Yeah, I think in terms of just maintaining an open dialogue between the investment community and the sustainability community as represented by corporates would be the ideal, because there is an education piece to this, and the investment community is very much playing catch up on a lot of this. So I think maintaining that kind of open, honest dialogue around what are the challenges that the sustainability committee or the sustainability professionals are facing, and what investment professionals are facing, and just maintaining that dialogue, I think is quite important. That's what I'd say.
And Amy, I think we have time for one more. I see a question in the chat from Veronica, if you see that one.
Yeah, that's a great question. Yeah, so Veronica has asked, I'm interested in the level of knowledge and experience in sustainability of the directors and trustees on the board. Does the panel think there has been a refreshing of boards to address this for ESG?
Yes, but I'm not sure. I can speak on kind of the explicit. It was 100% for that reason that board appointee was made, but certainly we would have a very diverse board with. I've seen these stats that come out with all the hundreds of emails we get every day, and they talk about like FTSE 100 boards that have no sustainability professional criteria. And I would struggle to see how, again, without getting into names, because I don't want to lose my job, I would say that we're covered in that respect. And again, happy to have that conversation offline with somebody if they want me to explain that a little bit better. But certainly, I think part of the refresh would be linked to that. Are we bringing an appropriate skill set for the challenges that we have in the future? Are they going to help us to be a better company?
I can't say. Yeah, I can't say it's something I've necessarily seen too many companies adapt to, but I think that boards have a lot on their plate. I think if high governance standards were maintained, in that we didn't see any sort of overboarding, we see suitable diversity in terms of skills and experience and otherwise, then I think a board is in a really good place. And I think that's where, if you have a structure so that a CSO has a reporting line to the board, that their voice is heard, I think that can often be enough. But it's not something I'd necessarily, upgrade or downgrade a company on that basis, I have to say. I think there's other ways of getting that sort of knowledge and expertise to board level, in short.
Okay, well, our time has come to an end. We're bang on the money, and if people are staying on for other sessions in the summit, it's time to grab a cup of coffee or whatever. But I would just like to say, our aim today was to make sustainability practitioners more aware of what ESG is in this fast-growing area. And Garrett and Brian, my sincere thanks. You've given us a window into your day-to-day. It's not only been insightful, but it's been inspiring. And I think for practitioners in the Institute, you've also opened up whole new avenues of career development as all this becomes much more mainstream in business and finance. So many, many thanks to you, and thanks for everybody for the questions, and Amy for managing that for us. If you want more information on ESG, we've given some resources to the ICRS. They're going to be popped into the right section of Hoppen. I'm not sure where that is, I have to be totally honest with you, but they will be in there. And also to Garrett's point of business wants bite-size, need to know, starter through to ambitious information on this topic. We've also given the link for ESG insights that we do across a whole range of these topics that you can have a look if you just want to really understand some of the key issues and some of the key things we mentioned today. So many thanks for everybody, and I'll say goodbye.
Thanks.
Thank
Thank
you
you very much.